Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. As always, we need to remind you trading is a risky endeavor and not suitable for all investors. We're very proud of our latest book, The Secret to Trading, Risk Tolerance Threshold Theory. It reached #1 on Amazon for futures. It's definitely in the top 5 bestsellers for foreign exchange also. It's a heavy book. We definitely encourage you to get that. We'll leave a link at the bottom of this video if you want to take a look at that. Let's get right to the markets. Currencies first, the Australian dollar, you could see Friday you had a little bit of a come down here. Markets start to break down a little bit. You haven't done any technical damage to it yet. Your 3 major patterns, the primary, secondary, day-to-day, are up, as well as that 20-day up. So you may or may not have shifted that 10-day. Looks like you did shift the 10-day south, bearish. On the other hand, everything is up. So really no technical damage to this market. We're still definitely interested in buying dips anytime you have the majority of patterns aligned like that. That's a market that you want to buy dips in. We see that end of week sell-off is typical of what we call counter trend Friday move. End of the week, a lot of players come out of their positions, leaving the market a little bit vulnerable. Obviously, that U.S. unemployment number, pretty bad number. They were looking for, upward close to 200. It came in at less than 100. So that definitely didn't help. That's going to add to the weekend weakness that we saw. Overall, that is a concern. We'll have to see how the numbers continue to come out. We're big believers that the pattern we see on the chart is absolutely a reflection of the underlying fundamentals. We have to keep an eye on both, not just the Aussie numbers, but the U.S. numbers also. Aussie really is it's almost a proxy for the global stock index, as well as being a proxy for China too. So, bottom line is that you didn't do much technical damage. The patterns are still bullish from our perspective. We're still interested in buying dips. Next market, the euro US dollar. I think the euro is probably a little bit overdue for some kind of a short covering pop here. Well, overall, we're still interested in selling rallies in it. However, you may have to let these shorts, the current shorts, get run out of here in the form of a spring short covering rally. The April, there's a pretty good seasonal, a bearish seasonal for the U.S. dollar. So accordingly, there's a pretty good bullish seasonal in April in the euro, for April. So that may or may not play into it. The bottom line, it's tough to be long the dollar, short the euro this time of year with that pretty powerful 30-year seasonal. And we've been saying now for the past month or so, wouldn't surprise us if you do get a short covering rally. We summed it up before, and this hasn't changed. Yeah, if you consider this the first leg down of a new move, essentially a resumption of the primary pattern, then all things being equal, if this is the first leg down, you could almost expect a correction of it. So we'd love to see this correction blow through and have opportunities to sell euro at more advantageous levels. Next market would be the yen. It's just remarkable how well behaved technically the yen has been. You can see you bottomed right on our risk tolerance threshold ratio level there, just as you did here also. You had a 50% retracement here. You went a little bit more than that, a little bit more than 618 this time, but nonetheless, it's pretty predictable, right? You had a hammer on that level, and then it looked like an inside candle. Then, bam, the Bank of Japan came out, and they goosed that market. They're taking a book from the U.S.'s quantitative easing. And, it's remarkable all the chatter you hear about that quantitative easing and what they're doing, what the U.S. is doing also. And I think it's important that everyone remember this, that it's not necessarily adding to government debt, by the way, if a central bank buys its own bonds, right? Take the Fed and the Treasury. The Fed is buying upwards of, 400 billion treasuries a month, right? Or actually mortgage-backed securities. If the Fed is buying them from the Treasury, and then at the end of the year the Fed gives its profits back to the Treasury, it's really not increasing government debt, is it? Essentially, it's just lowering interest rates. They're trying to put more money in the economy. If you can lower interest rates, people can refinance mortgages at a more advantageous rate. It's going to put money in people's pockets, but it's not necessarily adding to government debt, right? Because if the Fed is buying the Treasury's paying the Fed the receipts on those bonds, but at the end of the year, the Fed gives them back to the government. It's not adding debt, in fact. So you have to keep an open mind about that. And I know a lot of professionals understand this because you take one look at the U.S. stock market and you'll see, hey, it's been somewhat effective, and they're not going away with this either. And the one thing I think the Fed has proven too, and this is so apropos now because you're seeing the same thing in Japan. A lot of players, or I should say, a lot of analysts, a lot of people on the side say, well, what happens if when interest rates go back up? What if the U.S. debt market collapses? Well, hard to see that happening because the Fed has seen how effective they can be at buying their own debt. So when the Fed can buy the Treasury debt, essentially they can control interest rates. They can keep interest rates low. So if you ever did see a disproportionate amount of selling coming into the market by perhaps overseas bondholders or even U.S. holders of the Treasury debt, the Fed could just step up and buy it, right? And again, that's not going to add to government debt. So, it's hard to see this Armageddon scenario that a lot of people keep trying to paint about, the government buying their own debt and increasing government debt when in fact it's really not increasing government debt. And the other side of it is, what if the bond market collapses? Hey, markets are markets. Free market's going to do what it's going to do. We don't have a problem with that. If the pattern shifts south in the bonds, we'll go short south in the bonds, just like we would trade anything. But I don't think you have to worry too much about this doomsday scenario. What if central bankers get it wrong? It's kind of hard to get it wrong when you can buy your own debt and then give it back at the end of the year, right? Next market we'll take a look at it would be the U.S. stock market. And I think long-term professionals get that scenario that you're not actually increasing government debt if the Fed's buying Treasury debt, and that's probably a big reason why you've seen this bull market on Wall Street, because if you can refinance now, if an individual can refinance their home at a much lower rate, they're literally going to put more money in their pocket. So as the economy stabilizes, starts to pick up, that's a good thing overall. And again, it's arguably you're not increasing government debt. That I think explains some of it. There's so much confusion out there about that. Professionals get it. That's why the market's higher, right? So Friday, again, back to that unemployment number, you did a little bit of short-term damage early on, but the market still closed in the higher half of that range. If you go intraday here, take a look at an hourly chart. You had that bum number, right? Here, the number came out right here. Prices actually closed higher than where they were before the number came out. So, hard to say you did a lot of technical damage. You didn't. If you look at the daily chart, you didn't even get down to some of our support levels. We would welcome a shot at some of those support levels, see if price stabilizes down there. You get a short-term shift in momentum, and you can go long. So, you haven't done a whole lot of damage yet. You still have a pretty sturdy-looking bull market here. Let's take a look at the commodity markets now. Let's take a look at the gold market. I'm not. I could see where you have support down here, but I'm not buying into this just yet. I think that's a late Friday move. I think a lot of shorts ran for the door here because you had that bad unemployment number. I don't know if that's sustained. Here's the thing, though. I don't think any shorts want to try to press this market down into that level. I think they'd rather see it start to grind down and maybe the short covering rallies get smaller and smaller just yet. Because you don't want to be the first guy to run into the wall, right? I mean, you don't want to be a shock trooper. And I think trying to sell gold, the closer you get to 1520, that's kind of a shock trooper mode there. So I don't think anyone's going to jump ahead of that. But at the same time, I'm not so enamored with the upside of gold either. And hey, let's face it, gold's a commodity number one. Let's look at the commodities. Let's look at crude oil. And from my perspective, crude is still in a bearish mode. Let's look at the weekly chart. I think there's more downside than upside. The crude oil, in a word, Iran. Okay, if you didn't have Iran going full out to try to get that nuclear weapon, then I think that probably crude oil would be down somewhere closer to in the 60 to 70 range than the 90 to 100 range. So, if things start to get worked out there, I think it's a little more serious than the Korean situation, the Iranian situation. I don't think the Korean situation is all that serious either. But on some level, you can realistically look at Iran as not being all that seriously, because I don't think there's any doubt to the outcome of what would happen if you had a military intervention there. I think the Iranians would probably lose there, but that could get kind of sloppy. And that's why, you continue to see crude oil holding at these levels. We feel pretty strongly that, the Iranians, that's the Iranian tax. The globe has that tax as long as there's a threat of a nuclear Iran. Crude oil prices are going to hold up here. But we think overall you have a pretty good limit on it. We think you have a cap on crude, so we're more inclined to think that you'll see lower prices based on those higher time frame patterns. So, it's stubborn, holding just below 0.98 or so here, but we think overall, though, the patterns align bearish. And there you can see it a little bit more from there down. We think that was your last impulse move. We still see this as corrective price action. So we're still keeping the door open for lower crude oil prices, lower commodity prices overall. Here's the copper market. And you can see a pretty good weakness in the copper market. Even Friday, you had you had kind of I wouldn't call it a dead cat bounce, pretty good short covering rally in gold, but copper really didn't. You closed right in the middle of the range. So we think copper, you'll see potentially lower prices here. There it is, a pretty good shot at it. We think if you take out the what is that, the 2012 low, that opens the door to lower prices. Well, we think we're up for a test of that 2012 low. So look at copper, and we think you have some downside here. And I don't think you can count gold in as technically as an asset class market, and that's kind of the point I'm making. That's why I'm not enamored with gold, because I don't see it getting help from these other commodities. Here's corn. We talked about corn a couple weeks ago when we were together, and we were saying, we're recommending hedging at those levels it was at. Here's the daily chart, and that was a pretty good idea, wasn't it? Hedging in here, and corn dropped sharply too. So you can't lump gold in with the asset class markets, with financial markets, just based on its performance over the last year relative to stocks, relative to Aussie. So you really have to keep gold in the commodity camp, and commodities, not a pretty picture if you're a bull. If you guys are interested in what we're doing at Trading University, come and see us. Go to the Education tab, click on Live Market Analysis, and sign up for our free trial here. You can come and see us. We point out trade setups and signals in live markets. You can sign up there. Click on the free trial. If you want to get a little quicker start with us, you can always come and see what we're doing at EOS Trade, where if you open an account at EOS Trade, you can participate in that master's program for free. If you open up an account through Forex.com, FXCM, Open eCry for the futures, come and see us through EOS Trade, and you can participate in the program for free. Thank you so much, and we look forward to catching up with you next time.